The sanctions playbook, how SWIFT and oil-controlled global money sanctions are usually described as politics. A list of names, a list of rules, a moral statement. But in the real world, sanctions are something else. They are engineering. They are a way to control access, not with soldiers, but with systems. And once you see sanctions as systems, you stop asking the usual question, who is sanctioned? And you start asking the question that actually matters. What can they still do after the rails are cut? Because modern power doesn't only move through armies, it moves through payments, through shipping, through insurance, through clearing, through the invisible pipes that turn trade into money. This documentary is the Sanctions Playbook, how SWIFT and oil control global money, not as a conspiracy, not as a headline, as a mechanism. Because in the last half century, the world built a financial system so interconnected that the strongest form of pressure became denial of access, not a blockade at sea, a blockade in the ledger. And the moment you understand that, you understand why a single word can freeze billions. Sanctioned. Start with the most common misconception. SWIFT is not a bank. SWIFT does not hold your money. SWIFT is messaging, the standardized communication layer banks use to send instructions across borders. It's the language that tells one institution in one country how to settle with another institution somewhere else. And when you remove access to that language, you don't erase money. You isolate it. You force transactions to become slower, riskier, more expensive, and less trusted. You create friction in a system built to minimize friction. But SWIFT is only the first door. The deeper playbook is about something more fundamental. Correspondent banking. Because most banks can't directly settle with every other bank on earth. They rely on intermediaries, mega relobao, institutions that maintain accounts for other banks and clear payments through networks of trust. This is why sanctions matter. Not because a country can't send a message. Because the trusted intermediaries stop being allowed to help. And once intermediaries step back, trade begins to fail in slow motion. Now, add the second pillar, oil. Oil is not just energy. Oil is the bloodstream of global logistics. Most of the physical economy still rides on it. Ships, trucks, planes, fertilizer, plastics, industrial heat, and everything those things produce. So when sanctions touch oil, they touch the physical layer of global money. Because money is not only finance, money is also settlement for real goods. And oil is the good that moves everything else. Here's the core mechanism. If you can restrict a country's ability to sell oil, you restrict its ability to earn hard currency. If you restrict hard currency, you restrict imports. If you restrict imports, you restrict industrial maintenance and growth. And when growth shrinks, political and social stability gets tested. This is why energy sanctions are not merely symbolic. They are systemic, but the playbook doesn't rely on one leader. It stacks levers. And the most powerful sanctions are not a single ban. They are a network effect. The first lever is banking rails, SWIFT messaging, correspondent accounts, clearing access. The second lever is commodity settlement. What currency can oil be sold in? What banks can touch the transaction? What counterparties can legally buy? What documents are accepted? The third lever is shipping. Because you can have oil, you can have buyers, but if you can't move the oil, you can't sell it. And shipping is not just ships. Shipping is insurance. Shipping is classification. Shipping is port access. Shipping is contracts. So the fourth lever is often the quietest, insurance. Modern shipping runs on the assumption that if something goes wrong, fire, accident, spill, collision, seizure, the losses are covered. If insurers refuse coverage, ports refuse entry. If ports refuse entry, shipping becomes a liability. If shipping becomes a liability, many firms simply stop. Sanctions don't need to catch every ship. They only need to make the cost of risk unbearable. And then the market self-enforces. That is the real playbook. It's not just state power. It's private compliance, banks de risk, insurers de risk, shipping firms de risk, lawyers de risk, payment processors de risk. And in a high compliance world, the safest choice becomes no. No transaction, no exposure, no headline risk. This is how sanctions scale, not by force, but by fear of error. Now, if you've watched to this point, you already see the pattern. Sanctions are a machine that turns legal restriction into economic gravity, and the stronger the system's hub, the stronger the gravity. Because global money still has a center. It clears through a set of institutions that are deeply integrated with US and allied financial infrastructure. This doesn't mean the US controls everything. It means that if you build your trade and finance through a dominant network, that network can deny you. And denial is power. That's why sanctions feel different today than they did decades ago. Decades ago, you could sanction a country and still see workarounds flourish: cash, informal trade, regional banks, low integration. Today, the world is more digitized, more regulated, more interconnected, and more so sanctions have become more like a switchboard. But here's the part most people miss. The goal is not always to stop trade completely. The goal is to raise the cost of trade until it becomes unsustainable, to make the legal path narrow, to make the illegal path expensive and risky, to make the gray path uncertain. And uncertainty is the enemy of large-scale finance, because large-scale finance needs predictability. Now pause here if you like documentaries that explain the hidden mechanics behind money and power. Subscribe now. This channel is built for long-form, system-level stories like this, because the next part is where we translate the playbook into something practical. How to spot sanctions pressure before it shows up in headlines. The sanctions machine leaves fingerprints. You can see it in 5 places. 1. Payment routes. When banks begin refusing certain counterparties, trade doesn't stop instantly. It reroutes payments, shift to smaller banks, to regional intermediaries, to alternative messaging networks, to complex chains of accounts, and complexity is cost to settlement currency. When a buyer can't settle in the usual currency, they switch sometimes to euros, sometimes to yuan, sometimes to barter-like arrangements. But currency switching is not free. It changes hedging costs, liquidity, and counterparty risk. 3. Shipping and insurance signals. Look for sudden changes in tanker routes, new dark fleet patterns, unusual ship-to-ship transfers, changes in ISA behavior, or rising insurance premiums. When insurance becomes hard, shipping becomes weird. For commodity pricing, if sanctions bite, you often see discounts and shadow pricing. A sanctioned barrel may trade below the global benchmark, not because the oil is worse, but because the compliance risk is priced in. 5. Reserves and liquidity. When a country's access to reserves becomes constrained, it changes how it uses what remains. It may tighten capital controls, restrict foreign exchange, prioritize strategic imports, and reroute trade into whatever channels still function. Now, quick question. Which lever do you think is the most powerful? Banking rails, shipping, insurance, or oil settlement? Comment one word: rails, shipping, insurance, or settlement, and tell me why. Now, we need to address the big objection. People will say sanctions don't work, or sanctions always backfire. The truth is more precise. Sanctions are not magic. They are not guaranteed. They are a tool that works best when 3 conditions exist. 1. The target is deeply integrated into the dominant system. 2. The sanctioning coalition controls key choke points. 3. Private actors comply at scale. If those conditions are weak, sanctions leak, workarounds grow. Parallel systems emerge, and the system fragments, which leads to the second-order effect. The effect that matters for global money. Every time sanctions are used at scale, incentives shift. Countries begin asking, how much of our trade should run through a system that can lock us out? How much of our reserves should be held where access can be restricted? How much of our settlements should rely on a network that can deny messages, deny clearing, deny insurance? You don't need a country to hate the system to answer those questions. You only need it to fear the risk. And when enough countries fear the risk, something changes. They build redundancy. They build parallel rails. They diversify reserves. They experiment with new settlement corridors. And that is where SWIFT and oil connect to the larger story of global money. Because oil is one of the last truly global commodities. If the way oil is priced, insured, shipped, and settled changes, global money changes with it. Not overnight. Not as a headline, but as a slow shift in plumbing. So the sanctions playbook is not just about pressure. It's also about you apply pressure. The system adapts. The system fragments. New rails emerge. And in that reshaping, global money becomes less singular, more conditional, more complicated, which sounds abstract until you realize what complexity means in finance. Higher costs, higher spreads, more delays, more exceptions. Marty, errors, and errors are where crises begin. Now, let's make this concrete. Imagine a company trying to buy oil. In a normal world, they pay a supplier. The supplier delivers, insurance covers, transport, a bank clears payment, the books close. In a sanctions world, every one of those steps becomes a question. Is the supplier allowed? Is the bank allowed? Is the ship allowed? Is the insurer allowed? Is the port allowed? Is the paperwork acceptable? And if even one answer is uncertain, the easiest choice is to walk away. That's the hidden force. It's not a single ban. It's a cascade of no. And that cascade can move faster than governments because it's driven by private risk avoidance. Now connect this to today's world. In an era of higher rates and tighter liquidity, the cost of uncertainty rises. When money is cheap, markets can absorb complexity. When money is expensive, complexity becomes intolerable. So sanctions in a high rate world can bite differently. Not because the legal text changes, because the system's margin for friction shrinks. And this is why your headline, the one that matters, is not sanctions announced. It's sanctions enforced. And enforcement often happens quietly. A bank updates its compliance rules. An insurer refuses a policy. A shipping firm cancels a contract. A port changes requirements. No press conference. Just silence. And then suddenly trade volumes shift. So here's the final question of the documentary. If sanctions are the ability to deny access to the system, what happens when the system becomes too fragmented to deny? That is the tension of our era. On one hand, sanctions are powerful because the system is integrated. On the other hand, the more sanctions are used, the more incentives exist to fragment the system. So the playbook may be strongest now and weaker later because power depends on centrality. And centrality depends on trust. So the real story is not SWIFT alone. It's not oil alone. It's not even sanctions alone. It's the architecture of global trust, where it roots, where it clears, where it insures, where it settles. And if you want to understand global money, you need to watch those rails. Not the speeches, not the headlines, the rails. Now, one last comment prompt if you had to watch just one indicator to track sanctions pressure in real time: banking access, shipping routes, insurance availability, settlement, currency, or commodity discounts. Which one would you watch and why? And now we land this documentary. Sanctions are not just foreign policy, they are system policy. They work by controlling access to the rails of global money. SWIFT is one rail, a messaging layer that makes cross-border coordination possible. Oil is another rail, the physical commodity that powers logistics and underpins trade. And when you stack rails with shipping, insurance, and compliance, you don't just punish a target, you reshape the map of global commerce. So if you want more documentaries like this, subscribe. Next, we'll break down the next layer of the playbook: shipping, tanker insurance, and the dark fleet mechanics, how trade reroutes when the official system closes. Until then, keep watching the system, not just the headlines.